Hi, this is Dr. Patty Hatfield, and I'm back with the second part of my capital budgeting talk. The first one examined the 5 more popular techniques. This one we're going to get into some of the theory behind the 2 most popular techniques, the internal rate of return, which tends to be favored by industry, although net present value is a big presence now in industry where it wasn't years ago. But also look at the net present value, because again there tends to be a little bit more of a leniency toward IRR in practice, and we might look and examine why that may not be the best thing. So we're still working on that same objective in the course that we saw earlier. So I'm just going to pick up where I left off on the first video and just kind of summarize again in case there was some time in between for you to view these videos. We're going to be comparing the net present value and the internal rate of return. And one thing that we talked about in the previous video is that these 2 capital budgeting techniques will always give you the same accept reject decisions. Okay, so if the net present value is positive, you can be sure that the internal rate of return is going to be greater than the cost of capital. Okay, they will not conflict, and one will be negative and the other, will say you should go with the project. However, where you can run into a difference, and oftentimes do, will be when you rank projects. And that's important because firms have a limited capital budget, and so they can't invest in all positive net present value projects. They probably don't have a budget large enough to invest in all of them. So they're going to have to rank order projects and try to determine, how many they can actually afford to invest in, and then which ones. And if you rank order projects according to NPV and then rank order those same projects according to IRR, it's very possible you're going to get a difference in ranking decisions. And that's why it's important to look at the assumptions behind each of these calculations. So the difference that we see occurring in the ranking of projects based on NPV and IRR have to do with 2 things. One is the timing and the magnitude of the cash flows, and the second is the differing reinvestment rate assumptions. So let's take a look at the first one, timing and magnitude of the cash flows. What do I mean by that? Okay, remember these were the project cash flows we were looking at in the previous talk. So same 4 projects. I'm going to continue on with the same example. Same 4 projects. If we look at the timing and the magnitude of these cash flows, you should notice some things. First of all, we're going to throw out project A, okay? Because with it costing $1,000 and then it loses $500 total in years 4 and 5, we know that that's not one of the good projects. So we're just going to throw that one out now. So that leaves us with projects B, C, and D, all 3 of which had positive NPV. C had the highest. All 3 had internal rates of returns greater than the cost of capital, with D being the highest. And then all 3 had a positive, or I shouldn't say positive, above 1 for a profitability index, with C being the highest. Okay, so B, C, and D are, all 3 of those capital budgeting techniques agree that those are profitable, value-adding projects. But we can only pick one, and only one of those can be optimal. So how do we determine that? Well, do we rely on net present value or internal rate of return? Well, let's look first of all at the timing and magnitude of cash flows. So taking project B, for example, notice how you get the biggest chunk of your cash flows the last year. Okay, $1,300 the last year. Nothing in years 1 and 2. Okay, that's what we're talking about in terms of timing and magnitude. So with project B, you get really almost all your return in years 4 and 5. So keep in mind, when you discount those cash flows, Okay, you know, the farther out, your discount rate increases exponentially. So the farther out you go, the more severely those cash flows are going to be discounted. So that 700 and that 1300 is going to be discounted pretty severely. And then let's go to, you know, C is a little bit like B, but not quite as extreme. Let's go to project D. The timing and magnitude of cash flows are quite different there. There, the cash flows are more evenly spread out. I mean, they do increase over time, but at least you are getting some of your cash flow in year 1, 2, and 3. And then years 4 and 5, you know, they continue to increase, but much smoother in terms of your benefits coming in through the 5 years as opposed to project B. So in terms of timing and magnitude, you can see the difference in how the cash flows are coming in for projects B versus project D. Now, based on these cash flows for projects B, C, and D, I want to create what's called a net present value profile. And what a net present value profile is, it's taking these cash flows for these 3 projects and at every possible discount rate, graphing the discount rate to the resulting NPV. So in other words, you're calculating the NPV with a discount rate of 5%, then 10%, then 15%, then 20%, and whatever your NPV is, you're graphing that. Okay, so you'll see this on the next slide. So here are the net present value profiles for projects B, C, and D. And so you can see what all the possible NPVs for all the different discount rates. So the discount rates, they're on the horizontal axis and the NPVs on the vertical axis. So if I were to ask you which project has the highest NPV, how would you answer that? Give me a second. Well, the answer to that should be it depends, right? Because if you have a 10% cost of capital, which is what we had in our previous problem when we worked through this in the first video, we saw that at a 10% cost of capital, it was project B that had the highest NPV. And you can see that it barely does here, but it has the highest NPV. However, if the cost of capital, you know, there could be another firm looking at these same 3 projects, and if their cost of capital happens to be, let's say, 15%, then if you were to go up and look, you would see that it's actually project D that has the highest NPV. So what's important is, because of the timing and magnitude of the cash flows, the NPV may change its ranking on the project. So again, why does this occur? Well, if you remember, we talked about project B and how all those cash flows, really almost all their cash flows, came in at year 5. So as you increase the discount rate from 10 to 20 to 30%, those year 5 cash flows are getting penalized much more severely than cash flows that would have occurred in years 1, 2, 3, and 4, right? Again, the discount rate increases exponentially. For project D, the cash flows are more spread out. They do get larger over the 5 years, but they still are more evenly spread throughout the life of the project than for project B. So as you increase the discount rate, since you don't have all those dollars in year 5, then you know you've got year 1, 2, and 3 that aren't getting nearly as aren't getting nearly as hit as hard by the discount rate as your cash flows in years 4 and 5. And so the slope of the net present value profile for project D isn't as steep as the slope for project B. So as you have timing and magnitude of cash flows that are weighted toward the end of the project, you're going to have a much steeper slope for your net present value profile. So hopefully that makes sense. And then if you see in here that probably around 12%-ish, right in there, you know, they're kind of the net present values look to be about the same. So according to NPV, you'd be pretty indifferent between the projects. So again, this is giving you one more shot at looking at the timing and magnitude of the cash flows, and like we were talking about for Project B, again, see how that $1,300 cash flow in year 5, that's what's hurting Project B and causing the slope of that net present value profile to go down so fast. And since Project D is more evenly distributed, you don't see the slope being quite as steep, and C is just kind of right in the middle. The second reason we get a conflict in ranking between NPV and IRR is the reinvestment rate assumption differences. Okay, and this is really important on several levels. So I do want to talk about this. If you remember, the net present value discounts your cash inflows by the firm's cost of capital. So when the NPV calculation is being done, we are implicitly assuming that cash flows are being reinvested at the firm's cost of capital. Okay, we're using the cost of capital as our opportunity cost. We're discounting by the cost of capital. The IRR, that's not the case. If you remember with the IRR, discount rate is the IRR. So we are implicitly assuming that the cash flows are being reinvested at the project's internal rate of return. Okay, so two different reinvestment rate assumptions. So let's take a closer look at the reinvestment rate assumption for the internal rate of return. Recall Project D in our other video. Project D, we found, had an internal rate of return of 25.4%. So the way that's typically interpreted is if we invest in Project D and we get all the cash flows that we expect to get from Project D, we will earn 25.4%. So, just to remind you, here are the cash flows for Project D. So, Project D cost $1,000, and in return, over the next 5 years, we get $200, $300, $500, $500, and $600. Okay? So, let's say that you make that investment, and we assumed away risk. So, let's say that you nailed those cash flows. Okay, that's exactly the cash flows you received. What did you end up getting from that project? Well, if you sum up those cash flows, you ended up on a $1,000 investment, you ended up getting $2,100, just summing up the positive cash flows. So if I convert that to a holding period return, okay, and the way I do that is I just take the cash flows I received summed up, which is $2,100, divided by my investment, which was $1,000, and then I take that to the inverse of the number of years of the project's life. So the project had a 5-year life, so we'll raise that to the 1/5 power. Okay, take the inverse of that 5, and then subtract 1, and you get 0.16. So we convert that to a percentage. What that is telling us is that, yeah, we invested in this project for $1,000 and we got the cash flows we expected to get from Project D, but we didn't earn 25.4%. We earned 16%. But the IRR said we're going to get 25.4%. So what's up with that? What happened? Well, what happened was, in order to get the 25.4%, you have to reinvest the cash flows each year that you receive at 25.4%. If you do that, then by the end of the life of the project, you will have earned a 25.4% return. So that's what we're talking about when we talk about the reinvestment rate assumption. The IRR is assuming that you are reinvesting at the IRR in order to get that IRR on the project. Okay, so let me show you how that works. So let's suppose that you had an opportunity to reinvest at 25.4%, and you do. So in year one, when you get your $200, you reinvest at 25.4%, and so there I'm taking the future value of the $200 at 25.4% for 4 years, and the reason I'm doing it for 4 years, I'm taking it from year 1 to year 5 to the end of the life of the project. Okay, again, you won't have to be doing these calculations. I just want you to see what's going on behind the scenes. So it gets to accumulate 25.4% for 4 years. The $300 you get in year 2 gets to accumulate 25.4% for 3 years until we get to the end of year 5, and so on, right? Notice the $600 that you receive at the end of year 5, you don't get a chance to reinvest that money because the project ends at the end of year 5, and so that's why you just have the $600 there. So when you total the money received after reinvesting at 25.4%, now we end up with $3,099 rather than the $2,100 that we saw earlier. So now we can recalculate the holding period return. Okay, so we take our cash received, which is $30.99, divide that by our $1,000 investment, and again raise that to the inverse of the life of the project, so exponent of 1/5 or 5th root minus 1, and that gives us 25.4%. So that's how we get the 25.4%. So we don't achieve our internal rate of return simply by investing and then getting what we forecasted that we were going to get. We have to be able to reinvest that money. And we have to be able to reinvest it at the internal rate of return. Now, there's a number of problems with that. First of all, what that means is it subjects every single project to a different reinvestment rate assumption. So if you have project A that has a 10% internal rate of return, the reinvestment rate was assumed to be 10%. If you have project B that has a 25% rate of return, the reinvestment rate was assumed to be 25%. And so you've got an underlying assumption for every one of your internal rate of returns that you calculated that are different. And when you do that, then when you're comparing internal rates of returns, they're not comparable, right? You're comparing apples and oranges because you base them on different reinvestment rate assumptions. Okay, so that's a real problem in itself, is using the internal rate of return because of the different reinvestment rate assumptions. We'll go on to the next slide. Okay, so again, like I was saying earlier, let's suppose you have project A that has a IRR of 20% and project B with an IRR of 300%. You may think a 300% IRR never occurs. That's not true. I've seen many projects with very, very high internal rates of returns like that. They tend to be large risk projects, but yeah, we have them. So, but the problem is, if you get an IRR of 300%, you are assuming that you're going to be able to reinvest all the cash flows from that project at 300%. Okay, well, first of all, if I had an opportunity to reinvest cash flows at 300%, I would probably be liquidating every other part of the operation I could and throwing it into that 300% rate of return. right? So basically, by making that assumption, we are inflating the internal rate of return. Now, fortunately, we do have a modified internal rate of return, which I'll introduce in a bit, that helps with that problem. But it doesn't solve all the problems for us. So, is the IRR reinvestment rate assumption realistic? Well, it can be realistic if it's close to the cost of capital, but you'll never be able to get over the problem of comparing apples and oranges unless you happen to have internal rates of returns for projects that are equal. Unless you use the modified internal rate of return. And again, I'll show you that in a minute. First, I want to talk a little bit more now about the net present value. The reason Academe prefers net present value, and it has caught on in businesses now, and businesses are using it more than ever, is because all cash flows are discounted by the cost of capital. Okay, again, if you go back and you look at your formula, you'll see that the discount rate that's always used to calculate the NPV is the cost of capital. Therefore, there is an implicit assumption for all projects, all project cash flows, that they are reinvested at the firm's cost of capital. Okay, number one, that's more realistic because firms try very hard to at least, it's actually kind of conservative, they try very hard to at least reinvest at the cost of capital. And most importantly, it makes NPVs comparable. So you can compare the NPV of 10 different projects and they all have the same reinvestment rate, and so therefore they are comparable. To kind of drive home the point of this comparability of NPV and how important it is, we have what's called the value additivity principle. And so let's take a look at this as an example. So here we've got 3 projects with a life of 2 years and a cost of capital of 10%. Projects 1 and 2 are mutually exclusive, meaning that you will either invest in project 1 or project 2. It depends on which one's better. And then project 3 is independent, meaning that you will go ahead and invest in project 3 if it's a positive NPV project. Okay, so you'll decide between projects 1 and 2, and then project 3 is independent. You'll take it if it's a positive NPV project. And then in the last column there, I have your present value interest factors at 10%. So let's take each of those projects and let's calculate the net present value at 10% for each projects 1, 2, and 3, and also the internal rate of return for projects 1, 2, and 3. Okay, here are my results. The net present value for my 2 independent projects are $354 and $104. So that makes it pretty easy. For my 2, I'm sorry, I said independent. My 2 mutually exclusive projects, I would obviously prefer project 1 over project 2 because the NPV is higher. Let's look at the IRR. It agrees. Okay, so IRR happens to rank project 1 over project 2 as well. So both the NPV and the IRR give us the same ranking of a preference over project 1 over project 2. Also, both the NPV and the IRR agree that project 3 is profitable, the independent project, so we'll go ahead and invest in the independent project as well. Okay, now let's go ahead and reframe the same problem. Because if you think about it, really, the question we're asking, especially now that we know that all 3 projects are, have positive NPVs and IRRs greater than the cost of capital, the question really is, do we want to take projects 1 and 3 or 2 and 3, right? Because projects 1 and 2 are mutually exclusive. So do we want to take projects 1 and 3 or 2 and 3? So let's recalculate the net present value and the internal rate of return, summing up the cash flows for projects 1 and 3, and then for projects 2 and 3. So here I added 2 more columns. You'll see there in the second to last column, you'll see 1 and 3. So what I've done is I've summed up the cash flows from project 1 and project 3. So now rather than 2 $100 investments, I've got a $200 investment. And then project 3 gives us $450 in year 1, and project 1 gives us $550 in year 2. So I've got that set up for projects 1 and 3. For project 2 and 3 combined, again, we have a $200 investment with $675 coming in year 1, and then nothing in year 2. Now, let's just rerun the NPV and the IRR for the combined projects and compare it to the ones we got for the individual projects. Okay, so if you look and see, projects 1 and 3 have an NPV of $663 and an IRR of 212, almost 213%. Project 2 and 3 has an NPV of $413 and an IRR of 237%. So the NPV is still higher for projects 1 and 3, which is the same solution we got when we were looking at the projects individually. However, that's not true with the IRR. When we looked at the projects individually, the IRR preferred project 1 over project 2, and it liked project 3. So it suggests going with 1 and 3. But when you combine the cash flows, it switches its ranking to projects 2 and 3. You see the IRR is higher for projects 2 and 3. We call that a violation of the value additivity principle. Net present values are additive. So if you'll notice, the NPVs of projects 1 and 3 together is actually the NPV of project 1 plus the NPV of project 3. Okay, that is not true with IRR. And the reason we get this different ranking is because the reinvestment rate assumption changed, right? When you change the cash flows, by combining those cash flows, we get a different internal rate of return for each of those projects now, and so our reinvestment rate assumption has changed for those projects when they're combined. So again, major flaw with the internal rate of return. So, hopefully that kind of drives that point home. Okay, another problem with internal rate of return. Another problem with the internal rate of return is that if you have a non-conventional cash flow, you can get what we call multiple rates of returns. Every project we've worked with so far, except for project A, in the examples that we've been using in the first and second video, are conventional cash flows. A conventional cash flow is when you have a negative cash flow up front, so like an initial investment, followed by a stream of positive cash flows, so followed by your stream of benefits. That's a conventional cash flow. Unconventional is when you have more than one sign change. So for example, project A that we had in our lecture last time would be unconventional because we have a negative cash flow followed by a couple years of positive cash flows and then negative cash flows again. And those will occur because sometimes you might need to make an investment, you might have positive cash flow, maybe then you need to stop and retool or change the equipment in some way for some reason, and so you have another investment again. Okay, when that happens, the internal rate of return, because of Descartes' rule of signs, gives you a route or more than one route to the problem. Every time there's a sign change, you get a new route to the problem. And as far as internal rates of returns go, you end up with a solution for each route, and none of them are the real rate of internal rate of return for the project. So it's a problem when you're trying to use internal rate of return with a non-conventional cash flow. You really can't. To kind of demonstrate that, this is a classic problem that's in a lot of textbooks. It's called the oil well or oil pump problem. So let's say that you have a piece of land and you struck it big a few years ago and you found oil on that land and you installed a pump and that pump's been pumping out the oil, and now you're getting close to depleting that oil well. So you can continue with the same pump you're using, and that's what the first column is showing there. So if you continue with the pump that you're currently in place and you're not buying another pump, okay, the question here is, do we buy an additional pump for $4.6 million to pump the oil out faster? So again, to go through these columns so it kind of makes sense, if you do nothing, if you do what you're doing right now, you don't have to make any expenditures. So that's the first column. Without the new pump, you still use your old pump in place, and you'll get $70 million worth of oil by the end of year 1 and $40 million worth of oil by sometime in year 2, at which point your oil well will be depleted. Okay. With the pump, okay, you can buy a second pump for $4.6 million, and in return you'll get all $110 million worth of oil in year 1. Okay, but nothing in year 2, obviously, because you pump the oil wells dry then in year 1. So I like this. It's kind of a neat capital budgeting twist. You know, basically it's a time value of money investment. You know, is it worth it for us to pay $4.6 million to get that $40 million in year 1 rather than waiting until year 2? Does that make sense? So that's what column 3 shows. So those are the cash flows we're actually going to be evaluating. It's column 3. So there's your $4.6 million investment, and if we make it, it'll give us $40 million in year 1 rather than year 2, which is why you have the negative 40 in year 2. And so if you were to try to run an internal rate of return on this, because you have more than one sign change, we've got a negative number at year 0 and then again in year 2 and a positive in between. Because of the sign change, we would get 2 answers, and both of them would be incorrect with regards to the internal rate of return. Putting it another way, we have a net present value profile that intersects at 2 different places. I can show you that on the next slide. So with this oil well problem, if you were to draw the net present value profile, which I did here, looks like I had a little too much caffeine that day, but you know, keep in mind the internal rate of return is where the NPV is 0. So the 2 places where you see the net present value profile intersecting the horizontal axis, those are your 2 internal rates of return. So we have one right around, it looks like roughly 50%, and one close to 400%, and neither one of those are correct. So in summary, the internal rate of return does not discount all projects at the same rate. That's the biggest problem. Secondly, it violates what we call the value additivity principle. And then third, for non-conventional cash flows, there are multiple internal rates of returns, which is a problem. So the question is, why is the internal rate of return and payback used by over 90% of firms when evaluating long-term proposals? And as I've stated, you know, the NPV is going up in usage as well. But it has lagged. It's lagged behind the other 2. Internal rate of return and payback has been popular far longer than NPV. And you know, you can find lots of different answers, I think, for this question. What I seem to run into over and over again as I've talked to people in corporations is that if you think about it, the capital budgeting process generally involves people from all over the firm, meaning people from outside the accounting and finance area. So, you know, it could be, you know, a manager that, you know, has an engineering background. It's going to involve your sales team who's trying to forecast what the sales associated with this project might be. It's going to be cost engineers trying to determine what's the cost associated with this project going to be. So it involves people from all over, different parts of the firm. And so if you're trying to communicate to someone that has no financial background and you say, I think I like this project better, the net present value is $10,000 higher, that isn't going to mean anything to someone who doesn't understand net present value. But we all have an intuitive understanding of internal rate of return, or rates, maybe not IRR specifically, but rates of returns. So if you were to say to pretty much anyone, we prefer project B because the rate of return is 10% higher than with project A, anybody's going to understand that. Okay, we talk in rates of returns all the time. It's kind of a universal language. So for communication purposes, IRR is great. But for decision-making purposes, NPV in conjunction with the profitability index, if you have a limited fund, which, firms in general operate with capital constraints, they have so much money in the budget, you want to look at the NPV and the profitability index together to determine, which is the best project. And if you think about it, it should make sense because the larger the project is, so think about it this way, if you have a $10 million project and a $1 million project that you're comparing, now I know they're vastly different, but it could happen. It's a utility company that, say, needs more capacity. They can either add on for a couple $1 million to their current facility, or they might go over and just build a whole new nuclear plant somewhere else. Okay? Those are two solutions that are going to be very, very different in scale. Well, you would expect the one that you're throwing the most dollars at to have a higher NPV, right? I mean, the $10 million project should have a much higher NPV than the $1 million project. And so the profitability index allows us to scale that. So if you use NPV along with profitability index, the profitability index will tell you, okay, well, for every dollar invested, here's what you're getting back. And so if you have capital constraints, then using that profitability index is very, very helpful. Okay, so firms should be using NPV and profitability index, and like I said, and I already talked about payback and how it's used, I think, in the first video. Basically, firms tend to use it to kind of screen projects if they have a lot coming across their desk. And some firms have a requirement that they want their investment money back in X amount of years, and it's very arbitrary. It could be 3 years, it could be 5 years. I published a survey years ago. It was a pretty big standard deviation in the, what the required payback was. But again, the shorter you force that payback to be, the more biased your company is going to be in terms of short-term, quick payoff projects, which aren't necessarily always the best projects. Oftentimes, it's your long-term, more strategic projects that are more profitable in the long run. Okay, so we've picked on internal rate of return enough. So we have had for a long time this solution, and this is the newest thing to catch on in industry, and that's the modified internal rate of return. And so I'm going to demonstrate that because it does correct for some of the problems of the regular internal rate of return. Okay, the modified internal rate of return corrects for the reinvestment rate assumption, because when we modify it, and thank goodness there is an Excel function for the modified internal rate of return, it corrects for the reinvestment rate problem. We can force the reinvestment rate to be equal to whatever we want it to be, but generally we choose the cost of capital. And then again later I'll talk about the difference between cost of capital and hurdle rates. They're a little bit different. In theory they're supposed to be the same, but in practice they are different. But technically we're talking theory right now, so you'd want the reinvestment rate to be the cost of capital. And it also gets rid of the multiple rates of return problem because it can handle cash flow changes. So again, I just want to show you by hand what's going on behind the Excel spreadsheet. You will not be calculating this by hand, but you'll kind of get the idea of how it works. So here's a modified internal rate of return problem. I used Project C from our earlier examples. So we have a $1,000 investment followed by this stream of positive cash flows. Okay, and here, if you remember back when we found the straight unadjusted internal rate of return, it was 22.8%. And now what we're going to do is we're going to force the reinvestment rate assumption to be 10% rather than 22.8%. So we're going to force that down to, and if we force all our internal rates of returns to have a reinvestment rate assumption equal to the cost of capital, it makes our modified internal rate of returns comparable. So it really solves so many problems. So, the way we force that, or the way Excel will force that, is it will take the cash flows the positive cash flows that you see there in years 1 through 5, and it will compound them at the cost of capital to the end of the life of the project, rather than at the internal rate of return. Okay, so that's what you're seeing there. You're seeing that 100 turns into 146.40 when you compound at 10% for 4 years to the end of the life of the project, and so on for every year. And then we subtract the initial investment and add up the future value of your positive cash flows. And then I didn't really show the math for this because it's easiest to do on a calculator. But when you solve for the interest rate for a present value of -1,000, you have to actually drop the negative, and a future value of 24.65. You'll end up with a modified internal rate of return, it turns out, of 19.78%. But I just wanted to show you this to show you how the reinvestment rate assumption is being forced to 10% rather than the internal rate of return. So the unadjusted IRR again was 22.8%. So notice when we force the reinvestment rate to be 10% rather than 22.8, it brings that IRR down. Now here it didn't make a huge difference because we're talking about a project that is only has a life of 5 years, and the IRR isn't hugely high, so it didn't make that big a difference. But you take a unadjusted internal rate of return of 300% and say it's a 10-year project, and then you do a modified internal rate of return, and the modified, you could drive it down to any number, but may drive it down to 50%, because the thought of reinvesting at 300% is oftentimes just crazy. So that is a great use of internal rate of return as long as you use the modified version. So great substitute. Now what I want to do is talk about what happens when we have projects that have unequal lives. Okay, so here I've got 2 projects, Project F and Project G. And Project F costs $20,000 and gives us $12,000 a year for 3 years as our benefit. Project G costs $30,000 today and gives us $13,000 a year every year for 4 years. And we'll assume a 10% cost of capital. Okay, can we just calculate the net present values of these 2 projects and compare them? And the answer would be yes if you know you can't reinvest in either of the 2 projects. Okay, but if you could possibly reinvest in each of the 2 projects, then a mere comparison of the net present values is unfair to Project F, because you would basically be assuming that Project F has 0 cash flow in year 4. Okay, so let's look at the raw unadjusted NPVs for Project F and Project G. So since the $12,000 represents an annuity, I use the present value interest factor of annuity at the cost of capital, and we receive that annuity for 3 years. And then I subtract the initial investment. So my unadjusted NPV for Project F is $9,844. For Project G, we have a 4-year annuity on a $30,000 investment. So the net present value for Project G is $11,210. Okay, again, if we had no opportunity to reinvest in either one of these situations, then without a doubt we'd go with Project G, but that's usually not the case. Usually you have an opportunity to reinvest. So if we can reinvest, excuse me, how does that change the problem? Well, there's a couple different ways we could solve the problem. The first one I'll show you is called the replacement chain, and I'll show you that one first because it's more intuitive. So using the same problem I had before, here's how it would look with the replacement chain, where we assume that we can reinvest until the cash flows end at the same time. So you've got a 3-year project and a 4-year project, and the least common multiple would be 12. So we're going to assume that we invest in both of these projects for 12 years, which would mean that we would have to invest in Project F 4 times and then Project G 3 times, because with Project F you're investing every 3 years, and Project G you're investing every 4 years. Okay, so we could run a simple NPV based on those cash flows. Okay, and you're going to have to discount the net investments as well as the positive cash flows coming in. So if I go through and calculate the NPVs for the replacement chain, this is the result. So the net present values for Project F, so I just took that 12-year, $12,000 annuity and discounted it as an annuity, and then I discounted each one of my investments in year 9, year 6, year 3, and year 0 is already discounted. And I get $26,988 as my NPV. Excuse me, my NPV for Project G comes out to $24,082. So using the replacement chain, it actually turns out that Project F is more profitable or adds more value. The way we would interpret that is Project F adds $26,988 in value to the firm as a result of investing in it 4 times. That adds more value than does Project G. Now there's an alternative way of doing the same problem, and so you can see with the replacement chain we expand the cash flows so that they end the same time. The other way of solving the problem is the equivalent annual annuity. Okay, here's the equivalent annual annuity, and what you're doing is you're doing exactly the opposite of the replacement chain. Rather than expanding the cash flows so that they finally end at the same time, you go back and you see, okay, how much value is being added each year? So you shrink everything back to a 1-year annuity. So how much value is being added each year, taking into account the time value of money and our cost of capital, all that, okay? So with the equivalent annual annuity, what you want to do is you want to start with the raw unadjusted NPVs. So for Project F, we did that a couple slides ago. We had the raw unadjusted NPV of $9,844. And then what we want to do is we want to turn that into an annuity figure. So if I take that NPV and I divide it by the present value interest factor of annuity at 10%, it's my cost of capital, for 3 years, because it's a 3-year project, right? That NPV is the result of a 3-year project. That interest factor, when you look it up in the table, is 2.487. So when you divide, you get $3,958. So what that is telling us is that every year we're invested in this project, it's equivalent to an annuity added of $3,958, taking into consideration the time value of money. So that's why we're not taking 9,844 and dividing by 3, because, right, you get money each year and you can reinvest it. So it's the equivalent of adding $3,958 to the value of the firm. So we go through the same calculation for project G. So the raw unadjusted NPV for project G is 11,210. And remember, that was a 4-year project, so we don't get that NPV until year 4, right? We don't achieve that. So we're going to divide by the present value interest factor of an annuity at 10% for 4 years, and divide, and you get 3536. So when that net present value is converted to an annual value added, an annual annuity, we find out that project G adds 3536 in value to the firm every year. So since project F adds more value than does project G, we would prefer to go with project F. They're close, but project F is a little bit better. So either one of those are viable ways of evaluating projects that have unequal lives, but you shouldn't just compare, straight RRRs, and that's another problem with IRR, internal rate of return, and even the modified version is there's no exact rule of thumb that can be used to adjust for different lives, whereas there's a very objective rule of thumb to use, actually two, using the NPV when we have unequal lives. We can either use the supply chain or we can use the equivalent annual annuity. They're both good. One last thing I'd like to talk about with regard to capital budgeting is the idea of abandonment. A lot of times we will evaluate a project and we just evaluate it assuming that we're going to hold it to the end of its economic life. And, perhaps if we don't hold it to the end of its economic life and get rid of it sooner, we might actually make or create more value. And so this is called the abandonment problem. And I took this problem, and this was a real executive development problem I worked with a company years ago. What they were doing is they were trying to determine whether it was more beneficial for them to own their own cars to have their employees use. So they had employees that traveled quite a bit. So was it better for them to have their own fleet of cars and have their employees use the corporate fleet? Was it better for them to reimburse for mileage and let employees use their own cars? Or was it better for them to lease cars from a car rental agency and go that route? And so they were comparing the three present value of cost. And when they were evaluating their own fleet, I was asking them, I'm like, what are you assuming the life of the car would be? And they said, well, probably 5 years. And I was like, okay. So what I did, I really liked that problem. It was kind of different. It was unusual from some of the others that I've seen. So I basically took one car and decided to throw it together as an example, so you can kind of see how it works. So, you can imagine this being applied to a fleet. But all right, so my makeup problem is, Bling Pharmacy is proposing the investment of a delivery car that has a net investment of $22,500 and is expected to generate the following cash flows from increased sales due to delivery. Okay, so they're expecting to get increased pharmaceutical sales because they're delivering. Okay, that's where their cash flows are coming in. Now, I didn't put any inflation in those cash flows. Again, I was keeping the problem simple in the beginning, but obviously in real life, you would put the, inflation factors in. But I had already gone through all my calculations to get to my bottom line cash flows, and basically what I found is that having the car will increase the cash flows for the pharmacy $6,250 a year, every year for 5 years. And again, we're assuming one car for a 5-year period, because we figure at 5 years it will have been driven so much we'll want to get rid of it. Now, this works really well for cars, because with cars you can reasonably estimate salvage values each year. You won't be dead on, but you can still estimate them pretty accurately. So, if we were to just run this car for 1 year and then try to sell it, we estimate that the salvage value would be $17,500. If we ran the car for 2 years and then sold it, we estimate the salvage value to be $14,000, and so on. You can read on down the line. Okay, so by year 5, we estimate no salvage value left. Okay, so we've run it all the way down. If we assume a 10% cost of capital, that should be Bling. Should Bling invest in the asset, or should Bling abandon the asset at some point? Okay, and the way we solve that problem is we go through and we calculate the net present value for each year. But before we do that, let me just show you the way we would typically do. The way we typically solve this problem is say, do we want to invest in this car for 5 years? And if we do, here's 5 years worth of cash flows. Here it costs us $22,500. What's the NPV? And if we go about it that way, we find out, and I'm just using my annuity factor to discount here. So if I have $6,250 coming in every year for 5 years, discount at 10%, minus my $22,500 investment, I add $1,200 to the value of the firm, which doesn't sound like much, but again, I'm keeping my numbers small. So $1,192. So this would indicate that the project does add value to the firm, and so we should go ahead and do it. However, if we investigate further, is there something we could do that would add more value? Well, let's look at abandonment issues. In other words, let's take the net present value of the cash flows every year for the life of the project and see if the NPV is higher if we abandon before year 5. And so we see the results on the next slide. So here you can see the first calculation is the net present value if we abandon after year 1. If we abandon after year 1, then we will have only received 1 year of cash flows of $6,250, and then we assume we'd receive $17,500 in salvage value minus our initial investment, gives us a negative NPV of 900, a little over 900. If we assume we run the project only 2 years, we get $6,250, and notice I'm discounting by an annuity for 2 years. Discounting at 10%. The salvage value at the end of the second year was $14,000, and so we still have a negative NPV of $83.52. If we go 3 years, okay, and you get the idea, we do this for every year, in year 4, year 5, notice the NPV is highest for year 3. So if we get the $6,250 in cash flows for 3 years, Okay, and if we're able to sell the car for $11,000, that's the beauty of this project. It's very low risk, right? Because if we can't sell it for $11,000, then we don't have to. We know we can go ahead and keep it through year 5 and still add value to the firm. But if we can sell it for $11,000, then we'd end up with an NPV of $1,307. So our NPV is maximized at year 3. And so for that project that was looking at a fleet of cars, I had them do that as well to look and see, was it best? And, there were a lot of things to consider. You have to consider maintenance and so on and so forth. Maintenance increases obviously as the car gets older. And interesting project. And so it turned out that they were better off as well, abandoning before the end of the life of the car. It also turned out that owning their own fleet wasn't the least cost way to go. So that's called the abandonment problem. And so we have now completed the objective on how to conduct investment analysis and provide recommendations, and now you have some theory and then some special case information on what to do, and I thank you for listening.